Good morning, everybody, and welcome to Coffee with Casey, where we take some time every month, sit down, talk about the real estate market. This morning, I've got my brother Pat with me, who kind of helps run the Casey Samson team. So we're going to be covering a bunch of topics, but just a little house cleaning first. No close-ups today, okay? Because, you got to do, the long shots today, because... So I go to this dermatologist yesterday, and she's one of these people that carries that freezer thing, like a 6-gun. Yeah. And I walk in, I sit down, she goes, "Hey, how you doing?" And she starts literally burning my face
got my
up.
marks.
Yeah. And I'm like, well, wait a minute, I got to go on whatever, Facebook Live tomorrow. She's like, yeah, don't worry about it, you look fine. And it's like, no, I don't look fine. I literally look like I got the crap beat out of me in a bar last night. And anyways, so... Footnote, never go to a dermatologist, at least this crazy one with that. I'm sitting there, just one thing, then we'll get back to work. I'm sitting there, and all of a sudden, I'm smelling something. Something's burning. And I'm looking at her going,
it's your nose.
Is that me? Is that my skin? Is that my body that's burning? It's like they burn your body.
Literally.
Holy jeez.
They say they're freezing it off, but they're actually burning
Well,
it.
that wasn't freezing. That was burning, and that was skin burning. So anyways... That's just the reason why this is going to be like what is it, a League of Their Own, where they say, look at Marla Hooch, and they got the long distance thing for her. So we're going to talk about a couple things. Wall Street Journal came out this week with their top 1,000 teams in the country in the state of Virginia. The Casey Samson team came in at number 14. And I'm a football coach, and I'm a Marine. I believe in Ricky Bobby's theory, if you're not first, you're last. So anyways, we're going to talk about, big teams, small teams, what's the best thing. And Pat has so much experience with lenders. We're also going to talk more about the small, medium, or large lenders. You've got brokers, you've got correspondent lenders, you have banks. Which one is the best for you? And if you're a listing agent like we are, we really only accept one of those three. We don't even want to talk about the other two. And we'll go over reasons for that. We're going to talk about this hurricane that wasn't. I don't know if that's fake news or not.
I don't know. I don't know. It's questionable at this point.
Well, I went in to talk to Danny, and I said, sometimes I don't realize the power you really have, because we're playing golf today at 12:50. And when he said that, it's like the hurricane is coming right up at us. I'm like, dude, it's going to be right. He goes, that will be fine. And I mean, that hurricane the next day went like this and started bending off. So,
you mean
guys
a
got some
tropical
power.
storm. It's really not much of a hurricane.
It's not. But I'll tell you,
storm.
We were going to talk about some hurricane preparedness, and I realized that I'm the worst person in the world to ever talk about what you do to get ready for a hurricane. So we're down in Duck. Hurricane's coming in. The whole town is leaving. I got a big house. I'm not leaving. I've been running out of Outer Banks too often. I'm going to ride this sucker out. So, Carol and I, we bust over to whatever that is, Walmart or whatever, and I said, okay, we got to be ready for this hurricane. Go get hurricane provisions. And she walks back, and she's got a People magazine and a 12-pack of Evian. And I'm like, I said, wait a minute, is that your hurricane awareness thing? A People magazine and a 12-pack of Evian? And she says, yeah, I guess. So if there's ever a natural disaster, Carol and I are going to be the first to die. I mean, literally, we are not survivalists. We'll never make it. Even though I was a Marine, we're never going to make it. So I'm not going to give you advice. I know you put out something nice on the newsletter, how to prepare for the hurricane, but we're not going to talk about that.
Thank goodness. Thank goodness.
Yeah. So what we're going to do is we're going to go over market conditions. We're going to talk about the small teams versus big teams and what's best for sellers, small lenders, big lenders, what's best for them. We're going to talk about protocol. And this week there's a massive part of real estate is a home inspection. And should a home inspection get out of hand, you are going to blow this contract up. And there are tens of thousands of dollars at stake in these home inspections. A percentage of them kick out. When they do, a home loses its value because they realize that, something must be wrong with this house because they didn't get through their home inspection. So we're going to talk about the protocol for that and how we deal with it. Pat's really good at it. I'll be honest with you. Pat has got a lot more patience sometimes. I'm I'm a cut to the bone person, and Pat will be a little more patient with some of the other agents that we deal with. So and we'll talk about all that as we go along today. Okay, so let's look at market conditions real quick before we get into big team, small team, and all that stuff. Julie has a map or a chart up on online, and this chart is basically shows which, and again, when we're looking at market conditions, that is so dang funny that this thing would that my computer runs 24/7. I work on it every single second, and now it's just gone blank. But what this chart is showing you is what percentage of homes are under contract in the current markets. Now, we've been in a seller's market all year. From beginning to end, we've been in a seller's market. Currently, the markets we track, only one market left is in a seller's market. The rest are all sliding into a buyer's market. We'll talk about how we know that. So a market is measured by how many houses are on the market and how many are under contract, okay? So if there's 10 houses on the market and one's under contract, that's only 10% of the homes are under contract. Clearly, buyers are in control. There's only one buyer, there's 10 sales, buyers are in control. But if 7 of those houses are under contract and only 3 are active, then the sellers are in control because they're the ones that are making the rules. So for the balance of this year, until really this month, I really cannot believe this thing blacked out on me. That is the damnest thing I've ever seen in my life. I'm going to bust this thing.
Reboot it.
I'm hoping, no, it's too late because then but I'm hoping Julie has this up online where you can see. And as I remember, Julie, the markets that we're looking at, the Vienna under 1 million, I believe, is at 42%. And that's really the only market currently still in the control of the sellers. Then you go into Vienna over 1 million, and then Vienna over 1.4 million, and you get all the way down to 17% of the houses over $1.4 million in Vienna are under contract. So we're putting houses on the market every day. So sellers have to know that. I mean, if there's only 2 houses on the market and 12 are available, you know, that's a pretty powerful indicator that the buyers are under control. So when you look at this map, you can pick out your community. When we sit down with a seller, it's one thing to say your house is worth X. And then you have to look at the market to say, are we in control or are the buyers in control? Because there's a cone. Okay, so you know the cone you have for this hurricane. So I'm watching the cone for the hurricane. And the hurricane comes along like this, and the closer it gets to the shore, you have this big cone, which is like this. Well, the real estate market is actually the same way. So when houses are originally built, you know, the difference between the best house and the worst house, the one that's updated, not updated, we're only maybe a couple points away for 5 or 7 or 8 years because all of the systems are new, all the roofs are new, everything is new. But as we go on and we hit the 10-year and the 12-year and the 15-year, some people update their houses. Some people put nice upgrades in their houses, right? So when we walk in a house, we're saying, okay, the baseline for this house may be $800,000, but you haven't put a nickel in this house in 20 years, whereas normally, so you start at 800, and if it's after 15 years, the swing between the best and the worst is maybe 10 to 15%. And then once we get to 30 or 40 years, you could have nothing done to a house or totally updated house. Now you've got a 20-point swing. So let's say the average is 108% of your assessment. Some would sell for 98% of their assessment. Some would sell for 118. So this cone of has it been updated, hasn't it been updated, you know, what does the flow look like, all of that, what is the condition of the house. So when somebody says, well, what's my house worth? Well, I can give you the baseline of what your house is worth. A house in what we call customary condition is X dollars. But then we have to talk about condition, upgrades, and that's what brings you to the top of the cone or the bottom of the cone. So when you look at the websites, you know, we go on the website, somebody says, well, they said my house was worth $950,000. Well, another website said it's worth $800,000. And so there's a 20% swing in what the websites say your house is worth. Well, because they don't know whether your home has been updated, upgraded, good condition, bad condition, customary, extraordinary, or inferior. So a realtor has to take that baseline and know what the baseline is, and then decide, are you below the baseline? Are you above the baseline? And that's why that when I see the hurricane, I'm like, that's exactly the pricing way that the houses go, and why, the expertise is, what are the customary upgrades and condition for a house of this age, this size in your area? So I don't know how I tied that in the hurricane. We're supposed to be talking about hurricanes. I said, no, I think that's I think that's more of a model for how we price these houses than anything else, you know. But as we're looking now, everybody needs to be alert that we are sliding from a seller's market to a buyer's market. And
it happens this time every year. So every year is like that as we start to head towards the late fall.
It does. It seems like this has been a weird year because we really didn't have a killer spring. Nobody did. I mean, sales are down in Vienna. We're down in Vienna like 30% at one time. So we didn't have a killer spring. We had a great summer. Which it would usually be the exact opposite, right? Mm-hmm. And we had this killer. I mean, for example, I think in July of 2017 we did $3 million, and in July of 2018 we did $15 million. So for some reason, I think the buyers that didn't come out in the spring did come out in the summer, at least for our stuff, or it was just well priced and it sold. But I, still when we're putting houses on the market, we're still getting the contracts in. So I don't think that we're feeling the fact that we're in a big buyer's market, because we're still getting the contracts that we launched last weekend, still getting those things in.
I think we noticed a lot of new jobs coming aboard in spring and the summer, and that helped fuel the purchasing of homes. A lot of people came in. A lot of people that came into the area from out of the area came in, I think, during the early summer.
Yeah.
Most of the people that I worked, the buyers, were all coming from outside of the area, which is kind of unusual this time of year. But I think that's got to do with all the new jobs and jobs being created.
Well, let's talk about that for a second, because sometimes people will come to me and they'll say, well, we have the CIA coming right here in Chantilly, so this is going to help us right here in Franklin Farms or whatever. And what people have to understand is that there's a migration of buyers. So if a big population center, a big employment center comes in, let's say Chantilly, the migration is always west, 30 to 45 minutes west. That's where those people are going to look for housing. And the reason for that is, here you could get a 2,400 square foot house for, let's call it $700,000. But out in Percival, I mean, you get a mansion. Right. You get a mansion for $550,000, $600,000 with a pool and 5 acres and all of this. So
and new schools.
Right. So if you're 9. Kelly lives in Percival, and her school is a 9, and the intermediate school is a 10, and the high school, I think, is a 9 or a 10. So people have choices. I work here, and that's why Vienna is basically considered a bedroom community to Arlington and Washington, D.C. Yep. If you can't afford Vienna, or you can't find that size house you want there, you move to Oakton, and then to Oak Hill, and then you have the employment centers in this area feed to Centerville. And now the people out in Haymarket, bless their heart, people that live out in Haymarket stay in Haymarket. They love Haymarket, so they're not coming back. So they either don't mind commuting an hour and 10 minutes or an hour and 15 minutes, or they work somewhere around the Beltway, and they can get out there, get down that corridor. So, I agree. It's people just have to think that a big employment center next door to you is going to really benefit people that are 30 miles, down the road, which is...
As far as home buyers and home sales.
So let's go back now. Let's talk about, I want to talk about first of all, the Wall Street Journal, big teams, little teams. So our team was listed at 14. We did $95 million. We have 6 agents. So I don't know what that is. I think it's like $16 million an agent. So, of course, Ricky Bobby, if you're not first, you're last. I'm looking at the ones up on, that do $200 million, and they have 50 agents.
Or more.
Or more.
Yeah.
So they're all, doing it into that. I think you and I would kill ourselves if we had to manage.
Well, the problem is that there's not enough deals to go around, not enough sales and whatnot to go around buyers for that many people. So they don't have as much experience. They're only doing 4 or 5 or 6 settlements a year, as opposed to us, who are doing 30 or 40 or 50 a piece per year.
Right.
It just gives us more experience. We're more involved. we see more things, we can anticipate more things, we get more experience in the area. So some of these bigger teams, you're dealing with agents that potentially are only doing 2 or 3 settlements a year.
Yeah. Well, and it dilutes so we have control, I have control. First of all, the first thing to me that's most important is I go on every listing appointment and price every single house. Not one house is listed through our team that I don't sign off on that price. And I think that the value of our team is the expertise at pricing at least.
Yes,
no
getting
question. That going.
That's the most important thing.
So you have individual big agents, and you have smaller teams, and you have bigger teams. So what's the best? Well, why do we choose a smaller team? First of all, sitting over here to my right is a girl named Julie Hart. Well, Julie is an expert at marketing and branding for our clients. So she's a social media person. She packages houses up. She does the nice stuff, but it's got to be online. I mean, having a beautiful brochure doesn't do you any good if you can't get people in the house. And once they're in the house, the brochure is not going to sell the house. The house is going to sell the house. So, I realized earlier that it's all going online. The power of these Spark pages that Julie produces is phenomenal, and Michelle does is phenomenal. So an individual couldn't afford somebody like Julie to do this for just my team. So for one person, an individual agent that may do 20 or 30 or 40, they can't afford a full-time social media beast that is, and that's the only way to describe it because it's so much stuff going out there and tracking it, and Instagram and Twitter and Facebook and social media pages and Spark pages. So there's just no way that I, as an individual, could do 2 things. One, I couldn't afford to do all of that, to pay to have all that done. And 2, Danny said, why don't you have less deals and just handle listings yourself? I just can't. And I'm going to tell you here's the key to this. So when we sit down with a seller, they say, well, what's the differentiator between you guys? And it's not me. I mean, I'm great. I think I'm good at I'm a stickler on pricing, and we have a marketing guru that is wonderful. But the key to the transaction has got to be the other agent, the alt agent that's sitting next to me, because Pat may have an expertise with working with older couples that need more patience, that need to walk through a little bit slower. Pat's old school. They may be old school. They may not appreciate a millennial working with them, whereas Billy may have just sold 2 or 3 $1.7 million houses. So when you go into a $1.7 million house, he's just finished negotiating a contract for $1.7 million. Perfect person to have for another $1.7 million. Pam, we sat down in Oak Hill. Well, Pam's lived in Oak Hill for 30 years. She knows everything about it. And when they started talking to her about models, she was telling them about the models of the whole house. They were living in the house for 20 years. So the fact is, it's the expertise of the alt agent that they're a perfect match for whatever that seller is. And that we have 6 of us that we can say, well, Kelly may not be the right fit, but Colby's the right fit, or you're the right fit, or somebody's the right fit for this, or Billy's the right fit. So, I think the key is, A, I'm involved in every one. I go to every listing appointment. B, the alt agent, there's only 6 of them, and each one has done $16 million each. And each one of them has that expertise with that group. And we can afford to have Julie, and we can afford to have Michelle, which the way I would describe it is this. Without them, we're just a big cake. It's not bad. I mean, I don't mind cake, but it doesn't have any icing on it. Who wants a damn cake without icing on it, or frosting, I guess you call it. I don't know what you call it. So Michelle and Julie take us as a team, cake, and make it look great, but also they make all the houses look so damn good. Yep. I mean, that's an expertise unto itself. So I think that the individual agents, I couldn't do it myself. I couldn't afford Julie. I couldn't give the attention to detail that you guys give to these sellers. So I don't know that anymore that you can do it as an individual agent. I think it's got to be a team, enough team members that you would have a head that can do all the pricing and the protocols. And we're going to talk about protocol in a minute. And one of the keys to these teams is understanding what the protocol is for whatever you're doing. What's the protocol for the pricing? What's the protocol for the home inspection? And there's massive, very, very important how these home inspections tie in. So we're going to go over that protocol in a minute. So, you know, for our team, it's all about protocols and things like that. And then, again, then you would look at a bigger team and they say, well, if I can't sell your house, I'll buy it. Well, first of all, that's garbage because 40% of their listings withdraw unsold. Unsold. So, well, then why didn't you buy the 40% that you promised?
Because their offer is 50 or 60 cents on a dollar, the value of that particular house.
Right. So it's basically a worthless guarantee.
Yes.
So it's very upsetting to hear that because, you know, I sit here and I listen to commercials and I have a lot of respect for a couple of teams. I know they're good. I know they know what they're doing. But some of the garbage you hear on TV, I will guarantee to buy your house. Another great one is I have 6,000 buyers. Who's got 6,000 buyers? You've got 6,000 buyers?
In the internet.
Well, yeah, but everybody's got 6,000 buyers.
Right.
Yeah,
Exactly.
but what? Yeah. So they sell 6% of their listings, and they say they have 6,000 or how many thousands of buyers. They sell 6% of their own listings. We sell 30% of our listings, but not because we have buyers. When you put a house on the market, a buyer will come right to the selling or the listing company and say, here's what I want to do. I want to go through you. I want to get a rebate. I want to get cash back. You know, here's how we can do that. So we do whatever that is, 5 times the amount of houses we sell ourselves as they do, but those are not our buyers. They just come through us, you know, which
Right.
to me, you know, screams, why do they only sell 6% of their own houses? I mean, we're not even trying and we do 30%. So I'm not sure I can wave off on some of the big teams. And I knocked off the Ricky Bobby stuff about I want to be #1 and all that and feel pretty happy that it's the quality of that team of the alt agents and the protocols you use and just have a natural growth from there. Agreed?
Yep.
So let's talk about this protocol, you know, that I use. So we have a home inspection protocol, okay?
Yep.
And home inspections are crazy. I mean, can be out of control.
The worst part of the transaction.
By far the worst part of the transaction. So a lot of sellers will hear me talk about in the beginning, what kind of leverage do we have during this most important part of the transaction?
It's very important.
Do we have leverage or not? Now, how do we get leverage? If we set a price that will bring us in 4 or 5 buyers, then we have 5 contracts. So should something happen with one buyer, the first buyer,
Yep.
we go to buyer number 2 or 3 or 4, and it gives us leverage when we're negotiating. Just a quick example, the guy comes in with 115 items on his home inspection, and I've been sitting on 5 contracts. And I said, well, how many items do you want us to fix? And he said, we want you to fix all of them. And so we decided, I tell you, we're going to fix 3 items because those are safety issues, but we're not fixing anything else. And if that's not okay, we're going to contract 2 and 3 and 4, and you know. And they quickly agreed, you know, as long as we'll do the 3 items, then we're all in. So that is the leverage of a home inspection.
Absolutely.
But let's talk about the protocol of that and how, you know, how we decide what we're going to fix and what we're not going to fix, and then the receipts and all the rest of that stuff, the proper way of doing
I
that.
think it all starts at the beginning when we go through the home and the listing appointment from the beginning, and you can spot out things. You talk to the sellers, what's wrong with the home, what are we worried about, and you can already start communicating with them on the things that they're going to have to look out for throughout the process.
Right.
And I think it's very important that instead of waiting for somebody to see if they're going to buy your house with all these issues and problems, to fix them now, and let's get under control with that.
Or inspect them
Or
to make
inspect them
sure
to make
that
sure.
they are in good working condition.
So much of it's got to do with communication and quickly with the seller, because if you wait to communicate, once you get that list of items, you're going to freak them out. They're just not going to know where did all this come from? So I usually try to have that conversation at least 2 or 3 times before we even get into contract negotiation.
Right.
Because you want everybody, you want your sellers on the same page. Hey, we're going to expect, they're going to probably bring us in all these different items potentially and on a home inspection. So it helps when we price the house. It helps their anticipation once they get the offers. Then once we do the home inspection, they're already on edge about all those things. So if they're thinking about 100 and only 30 items come in to fix, first of all, they're more relieved because they were thinking a big list. And then we can whittle that list of 30 down. But it's very important to communicate that up front. I learned early in my career in real estate that if you waited until that home inspection report came in with the list, you are in big trouble with your seller because they're thinking that everything's fine. They've lived in it for the last 10 or 15 or 20 years. They enjoy it. If it's got a little this out of place or that out of place, it's not that big of a deal to them.
Yeah.
But to the buyers, the new people,
And
they
the
want
first
a new
word
home.
out of a seller's mouth is, I'm not fixing anything in my
Right.
house. You know,
That's
I did a
correct.
great job. They don't want to buy the house, don't buy the house.
They're insulted.
That's not a realistic thing. So when we get that home inspection, the protocol is, look at it and determine, is it electrical, heating, cooling, plumbing?
Yep.
Is it a function of age or condition? So let's say that we look at the stuff and say, we know we've got a 2008 HVAC unit, and we know we've got a 12-year-old this, and a 18-year-old roof. We disclose all that up front. So the price of the house comes in at $750,000. Now they know all of those items on that, what we call our hot sheet. It's very important that we give them, the buyers, the hot sheet before they do the contract. So they come in, and the first thing we do with that list is we say, this wear and tear item is already in the price. You knew it was an 18-year-old roof, so we're taking that off the list. Yeah, but he said it's an old roof. I know, so did we. So what we don't want to do is, we don't want to take a lower price because we have an older roof and then have to pay for a new roof.
Pay for a new roof.
Right.
Paying
So
for
it's
the
like,
price.
that's already in the price. So the first thing we need to do is look at that list and say, we've already put that in, we've already disclosed that.
Yeah.
That's
Yep.
in the price. So is it in the price or not in the price? Now, if there's a concern about a foundation, then have another inspection. If there's a real concern about a roof, then have an inspection. But if you have an 18-year-old roof, you better have inspected it first. You better have something from a roofer to have that. So let's say that there is a problem with the roof, and we determine that we've got 5 items that we're going to fix, okay? So the normal protocol, and this saved us from a very ugly scene this week. So the protocol is, we're going to agree to fix it. We're going to fix it with a licensed contractor. We're going to give you a paid receipt, and then you're going to inspect it to make sure it's done, and then we're done. And if that licensed contractor, who's a reputable licensed contractor, says that is fixed and fine, and then that's what we have to rely on. So this week we had this transaction. We had the buyer. They have a 4700. Check this out. You're not going to even believe this. This is the craziest thing I've ever seen. So. And you know the seller, landlord, commercial landlord. Most of these buildings are all he manages. So I know he's a tough negotiator guy, So we're buying his house. It's a $4,700 roof that needs to be replaced, or it needs to be repaired. And there's a long laundry list. So, he gets it done. He gives us a receipt. It's a kind of a weird looking receipt, but it's a receipt. So our inspector goes up. He said, they haven't spent anything on this. This is a joke. This has not been done properly. Nothing's been done properly. So we go back, have another contractor go in, fix it, we'll inspect it. So we go to walk through, and I said, I need that receipt. He goes, and he starts yelling at me. He goes, that's been settled. The roof has been settled. It's off the table. Don't even talk to me about the roof. I said, really? What are you talking about? The guy is a licensed broker. He invited her to a neighborhood cocktail party. She was at the cocktail party, 2 glasses of wine.
This is the inspector.
No, this is the seller.
The seller.
Who's a licensed guy. This is the seller.
Went to the seller.
The seller walked into the cocktail party, had her sign the document, and release the roof.
Oh.
Showed her a picture of a couple of shingles and said, this has been fixed. Sign this document, let's go. So when I found out about that, you went to a non-licensed person, a buyer, you had her sign off on something after 2 glasses of wine at a cocktail party?
Wow.
You didn't go through me? He says, you got nothing to do with this. You stay out of it, or I'm going to have your license. Is that crazy?
Wow.
It was the damnedest thing. So at this point now, and this is real estate, at this point we have somebody that's trying to bully this seller and try and bully an agent and all this stuff. It's like, look, put the bully negotiating tactics away. The protocol is, you fix it, you give me a receipt, we inspect it, and we're good to go. So we held it nest, kept the money and said, I'll figure it out. So I do some research. The contractor that fixed it initially has been suspended by the state of Virginia. He's no longer a roofing contractor. He's got an F on Better Business Bureau. He's got a 1 on Yelp, and he's not even offered on Home Advisor, right?
Mm-hmm.
So the first guy was a problem. Second guy comes out, does not have a roofing license. Now, we're talking about a $40,000 cedar shake roof. Is that the damnest thing you've ever heard?
Why would he do that? I don't understand why a seller would do
I
that.
can't even fathom it.
Why not just get a licensed person out there, get it done correctly, and be done with it?
The receipts look like you went to the Staples and got a thing of receipts and typed your name on the top and then wrote them out and said paid in full. It's the damnest thing I've ever seen.
Wow.
So anyways, money's in escrow, Catchmark, right? Reputable, good, solid roofer.
My next door neighbor.
Next door neighbor. So Catchmark is going to go out, they'll inspect it, we'll get this done. But at this point, and the reason for this story is it's a crazy circumstance that happens in transactions, and should we get bullied by this person, you could have a $5,000 or $10,000 problem on your hands.
Even more than that eventually.
Right, $30,000 roof.
Yep.
So anyways, you can't get bullied. You know, his license is in jeopardy, not mine, because he literally went around me and he's a broker.
That's crazy.
Is that the craziest thing you've ever heard?
Unfortunately, though, that happens, and I've seen that happen before.
Yeah.
It is crazy that when they just push the professionals out of the way and try to do something together, it always ends in disaster one way or the other.
And so what we really need to do is make sure that, and for all you people that are out there listening, whether you're a realtor or whether you're a home seller or buyer, never, ever, ever talk to anybody or sign anything unless you go through your realtor. Your realtor represents you from beginning to end. So if somebody puts something in front of your face, say, send it to Casey, or send it to Bob, or send it to Mary, or send it to whoever my agent is. Never, ever, ever sign anything unless it goes through your agent. You're represented by an agent.
Yep.
They do this every day. They know the proper protocol. And I can guarantee you one thing: the proper protocol is not to go to a cocktail party.
Right. Well, the problem is, it's for a buyer and a seller, it's the most emotional transaction that you'll do in your lifetime is buy and sell.
Very strenuous.
You're extremely emotional. You want to get something done, whereas we're third party and that we have no emotion involved in it. We're there to make sure that everything works correctly for everybody and that it's done correctly. So you want to separate yourself from making those decisions because you're in a very emotional state at that time, and that's the reason why you have us. That's the number one reason you have a realtor there, other than marketing your home. It's to be there when these emotional transactions happen, and we're there to separate and make sure it's done correctly.
Yeah, you're better at that than I. You're better at keeping your calm.
Well,
you're good at keeping calm in those situations. I looked at him and I said, "Don't you come at me," with the attitude. It's like there's a proper way to do things, and that's why, again, when we all run into things, we go back to the rules. We go back to the beginning. We go back to the protocol. What is a protocol? If you follow the protocol, these things don't happen.
My experience tells me, and we've gone through, God, in our lifetime, 1,000 transactions, is that half of them get into these, the agents start going after each other. But I've learned over the years that 99.9% of the time, we all end up at the settlement table shaking hands and happy. So you got to get through these emotional things and realize that we're all going towards the same goal, and that even though it does get emotional, keep your calm and just relax, and everything will work out. It always does. You just let everybody recede to their corners, take a deep breath, come back, and eventually we work our way down the same path together.
And it is funny, and we had one of these within the last 40 days, people say, I'm going to get an attorney. Well, first of all, A, nobody gets an attorney. B, nobody ever sues anybody. They threaten through this process because I'm going to go get an attorney.
They think that's leverage.
They think it's leverage. And really, what it is it's a form of intimidation.
Right.
And, as long as you're in the right, as long as you're following proper protocol, then you don't have to worry about that. As we say, there's a right way and a wrong way to do everything, and if you don't do it the right way, then you're done.
Eventually, everything gets worked out to everybody's liking. It might not be 100% of what the seller wants or the buyer wants, but we eventually get to the center point together, and it all works out. So there's no need for the emotions.
Yeah.
And you just keep taking a deep breath.
Yeah. Let's switch over right now. Let's talk about the lenders, okay? Mm-hmm. So we've just talked about an individual agent, which I think was the way to go in the day. But a team now, even though I didn't want to be a team, but Kelly made me be a team, at least a small team where you've got control of all the elements in that team and all the the top producing agents on that team, versus the monster teams. Well, the same thing kind of holds true now with the lenders.
Yes.
We have the brokers.
Yes.
And a broker is well, why don't you walk us through the three elements of small, medium, large here are broker, correspondent lender, bank.
Big bank.
Okay,
Retail
so who do we
banks.
use? Yeah.
Well, I think a correspondent lender, the one in the middle, is your best choice. Correspondent lender is exactly what it denotes. They correspond with all the banks or most of the banks. And what they're able to do is they're able to get a bank product from Citibank or from Wells or from wherever, and then they pick what's best for you, and then they're able to get you into the best program. A broker is an individual who has to literally walk in the front door of every bank and try to figure out what deal's there. The brokers really are not the way to go. The big banks are retail, and they don't take as much time. They don't care about you, just really a number in line. So working over the years, I actually was a correspondent lender for 10 years, and seeing the inner workings of how that works, you absolutely want to work with a correspondent lender.
Right.
How do you know it's a correspondent lender? You ask them, and they'll tell you that if they're a correspondent lender, that's who you want to work with. The other idea is, I just lost my train of thought.
Well, let me go back and let me just talk about some of the banks. So we won't take a bank. When
Especially
somebody comes in.
a long distance bank. If you're corresponding or you're talking to a bank in Charlotte or someplace else, we have no control over
And
that
even
transaction.
if somebody walks in with one of the top 3 banks around here, and we have a list that I'm not going to publish and get sued for, but if you walk in with a letter from that bank, I'm not interested in that. I mean, if you're going with multiple contracts, I need to see a pre-approval letter from one of the correspondent lenders around here. I'm talking about First Heritage, which is a real good one, and that's who we use. In fact, we just had a $1.3 million guy had a loan, and he was going with the internet. And I said, I'm not going to take that internet lender because we don't do that. And I said, you have to go to a correspondent lender. You start with ours.
And the reason why we don't go with the long distance lender is because
They
we have
promise
no
to deliver.
control.
Right.
I mean, if you show up to the settlement, you've signed a contract, you have to be there on X date, and you have now said that your lender has agreed, long distance lenders agreed at 4% with no points. You show up the table, it's 5% and 2 points. It's not like you can get up and walk away on
Right.
that. And that lender is out in Des Moines, Iowa. somewhere.
Soho or SoHi.
If it's a correspondent lender, a local one right here, we can literally go into that person's office and sit right in front of them, and we can control that. We can't control that long.
Well, they live in the area and they depend on all of us.
They depend on us for their business, and they don't want to lose a reputation. A long distance guy could care less. He's just doing as many multiple deals out there as
Well,
he can
and in
get.
fact, the guy called Mike Filan from First Heritage, which is our guy, and he had his rate was actually an eighth of a point less than the lender. So of course he's going to go with First Heritage, but I just don't feel comfortable with other banks. And we're going to take our house off the market.
Yep.
And we're going to say we're under contract, and my sellers are getting ready to move out, all based on what? This bank?
Yep.
And the reason why I don't like the big banks is if something goes wrong, we're on an 800 number. And they really don't care. I mean, you all have been on with a bank and an 800 number. I have nobody to talk to. I have no control. And that's number one. But number two, they will have appraisers that are coming from all over the place. And, could be coming from Frederick, Maryland to do something in Centerville. And the appraisers are low. They don't get paid as much, and they run in, they run out, and they walk, and I don't think they really care. But I keep having problems with their appraisers, and when I try and fight the appraisal, they won't even listen to you.
Well, the important thing about an appraisal is that it's by neighborhood in most cases. So if an appraiser comes in and he doesn't understand that this neighborhood sells much quicker, it sells for a better price, it's got a better community, the elementary school's better, so it's much stronger in that neighborhood than that neighborhood. A guy from out of town has no idea that. He doesn't get that. He doesn't understand that. A local appraiser understands the value of each neighborhood and each property.
Anthony Appraisers, Mike McNaughty, he works this area all the time, so he knows that there's a 5% premium on Lakevale as opposed to not Lakevale.
That's correct.
Same kind of house. Why? Because they have a community, they have a pool, they have a pond. Pond is good.
Pond's good.
Yeah, pond's good. So they got a pool and a pond. But anyways, he knows there's a 5% premium for a Lakeville house. So that's
correct.
He'll
One of the other reasons, too, for not using a big bank has one a group of their product. They have what they can do with an FHA, what they can do with a conventional loan. And if you don't fit in that box, they might think early on that you do, but if you don't, you get kicked out. They don't have other product lines to take you to. They have one product line. And so you want to deal with a correspondent lender, because if he takes you to Wells and all of a sudden Wells can't underwrite for that particular product, they can shift quickly to another bank.
Right.
Whereas a big bank can't. They don't shift. They have what they offer, and that's it.
You were behind the scenes with your lender for years and years and years. How many lenders? Let's start with that. How many banks would you say those correspondents deal with?
Well,
10, 14,
yeah,
20?
I would say it's a lot less now than it was 10 or 15 years ago.
Okay.
10 or 15 years ago, anybody could be a bank, anybody could be a lender. Obviously, the regulations after what happened in 07, 08, just everything really. So now the correspondent lenders are dealing with less. They're dealing with probably 5 or 6 or 7 other banks. More are creeping in again. Unfortunately, we're starting to see all those subprime products that we got killed by in the 07, 08 period. They're starting to creep back in. So you're starting to see some side lenders coming back into the game. But for the most part, they have 5 or 6 basic banks that they work with.
Yeah. Okay.
The big ones, Wells, Citi, so Capital One now is big.
Yeah, I think the other positive thing about the correspondent lenders, and the reason why I'm promoting them is because those are the best. That's your best alternative.
It's just the best way to go.
And the best closing of this whole thing is they're underwritten in-house. So let's say you go to First Heritage. There's others, but we just use the word First Heritage because that's who we use. So they use their underwriting, and their underwriter underwrites that thing in-house, and this person is trying to make sure they help out.
Correct.
Now, if a broker comes in, you just said it perfectly the other day, a couple of minutes ago, you said the brokers come in the front door.
Front door.
And the correspondent lenders come in the back door.
That's correct.
Yeah, so the correspondent lenders close their own deals in their own name.
Yes.
And their own warehousing lines, and their own underwriters.
Yes.
And their own appraisers.
That's correct.
So they package those up, move them out in bulk to banks.
Back to the banks. And they underwrite for those banks. And it's very important, because if all of a sudden a deal falls apart at the underwriting level, the underwriter knows, I can't do it with Citi, who we've got it set up with, but I can move it over here because they will accept this.
Right.
So she understands right there.
The
So
components of all the different
if we need to shift and move quickly, if we find out that somebody's job, they just lost their job, they're getting a new job next week, if something changes during the process, that 30 or 45-day process between ratifying a contract and going to closing, they can shift and move on a dime. A broker can't do that. A broker's got to go out and he's got to run around trying to figure out, well, who can do this loan?
Right.
A big bank, again, has only got one line. So you want to stay away from those two guys. It's the correspondent lender and their underwriter that can help you move amongst all the lenders.
And it's also about some of the programs. I mean, I think right now the best program is a 10-1 ARM. Rates have ticked up a little bit, but most people are either in their house for less than 10 years or the market dips down way low within the 10-year period. So it's a time, it's an opportunity to refinance. But I think 10-1 ARMs are right now, some of the better products. And let's say only 2 or 3 of the banks out of the 7 that they're using have that 10-1 ARM. Then at least they have the flexibility of using the product.
And I don't disagree with that, but at the same time, I think if the economy keeps booming along like it is, and we expect it to continue for a while, rates are going to continue to go up. So what happened to us back in 07 and 08 is we put everybody in 5-1 ARMs, 7-1 ARMs, and they were really great rates at 5%, which was a great rate back then. And when 30-year fixed were sitting at 6.5%, 7%, and all of a sudden the rates went right up past that, and people got caught up in these 5-1 ARMs.
Yeah, but they were tagged to the LIBOR, right?
Somewhere there were 2.
LIBOR plus 2.5.
Yeah.
So let's say the LIBOR was at 1.5 and they were at 5.5. So it was, when it adjusted to LIBOR plus 2.5%, which is a 4%. So they actually, some of them went from 5.5 to 4%.
Yeah.
So it really depends on where the LIBOR is. Now the LIBOR, I think, has gone a little crazy lately.
It has, and will continue, I believe, in the near future, and who knows where the long-term future is, but certainly in the near future. So I don't disagree with you. A 10-1 ARM is safe because it's 10 years before you have to worry about any type of an adjustment to the rate, terms, or otherwise.
Right.
So I think a 10-1, but I just hate to see people drift back into the 5-1, 3-1s again. you're anticipating that the market's going to be the same 3 to 5 years from now, and that things aren't going to start rolling up. So, yeah, it's long-term 10-year, but I'm not sure there's that much difference between a 10-year and a 30-year fixed rate this month.
Yeah, I think he said it's 3/8 of a point or something like that.
3/8 of a point?
You know, that's, again, here, let's go to another reason. So, banks are Fed loans. Everybody from their bank. So let's say that Michelle here is a mortgage banker. And you always wanted to be a mortgage banker, didn't you, Michelle? I always wanted to be a mortgage banker. He was going to kill himself. Oh, no, that's Kramer, sorry. That he couldn't be a mortgage banker. So, but let's say that you work at a bank and people call you all the time and you're just telling them, well, you don't have to be that competitive because they just fall off the turnip truck and they come to you, right? So there's a big difference between a loan officer that's working for a correspondent lender that's out working with realtors, meeting with realtors, dealing with realtors, trying to keep the realtor, trying to make the realtor happy, trying to, you know, that's where they get their business. So they're working, they're hustling to get their deals as opposed to having the deals come to them. So they're much more customer oriented, and the discussion that Pat and I had is the discussion you would have with a good, solid loan officer with tons of experience. What should I do? Should I do a 30-year fix? Should I do a 10-year arm? Should I do a 3-year arm? Well, let's just say that I'm with a bank and they only have a 5-year arm and a 30-year fix.
That's correct.
Right?
And that's what happened back in the day, by the way.
Yeah.
HSBC was a big bank, and they've long since gone away, but they were a big bank, and their big thing was a 5-1 arm, and they really pushed the rate down. The problem was that the index, which was tied to the LIBOR, it rose really quick. And what happened was all those loans went bad. HSBC ended up going down. They went down with a lot of the big banks back then. But yes, so that was their product. They pushed that product really hard.
Well, Countrywide, IndyMac. Well, they were, you know, just so everybody knows and you weren't here, you know, we talk about what happened back in the day and why did we get in this mess and how did it affect everybody. Here's the prices of some houses back in 2007. And here's where they went, like this. And then they went up back to here. So right now we're actually at the same prices. So when people talk about a housing bubble, it's like, well, our housing prices today are where they were in 2007. Now, why did that happen? Why did we lose value? Pat and I were right in, you know, we were right, you're right in the middle of it, I'm right in the middle of it. And what happened was, back in the day, I kind of walked out in a room, I said, geez, you could get a ham sandwich alone right now with these mortgage products. So, and Pat was warning about it and warning about it and warning about it and warning about it. And again, you know, you sell what people buy, and this was in 2006 and early 2007.
5, 6, 7.
5, 6, and 7. And so there was, in order to buy a house, you did not have to come up with any down payment. Your credit was questionable. Your assets were no verification.
You could state your income.
You could state your income, state your assets.
So a teacher who made $40,000 a year that was on a W-2 was stating their income at $100,000 so they could buy another house, an investment property.
So let's explain what happened.
With no money down.
The amount of homes that were sold went from here to here.
Yep.
Because more people were buying. Now, a majority of those
and that's what pushed the prices
up.
And
somewhere along there, it went from people that were on the outskirts, it really is good for them to buy a house, to people that never should have bought that house in the first place. So it kind of went, as you just said, Michelle, the pendulum swung too far to the allowable loans, okay? So then what happens? Everybody buys a house. Housing prices go way up.
That's right.
Gainesville, I'll never forget, they were buying houses for $650,000. So I blame this all on the banks. I blame it all on Wall Street. I blame it all on whoever was running the show and regulating these banks at the time. Because here's how recessions go from small blips to massive problems. Banks open up the amount of people that can borrow, and then once they run the prices up, they slam the door to even only the perfect people can borrow at that time. So this makes it go too high, and this makes it go too low. And that's why I went like this and then like this. So, you know, and that wasn't the mortgage bankers or a mortgage broker. The mortgage people sell the products that are in the market.
It was all Wall Street.
These are the products that you sell.
They were creating these tranches of money, and they needed to get it out there, so they started saying, you don't have to do this, you don't have to do this, you don't have to do anything, basically, and you can get a loan. And so they had all this money, and they were throwing it out there.
They were creating what's called boutique tranches. So let's say you take a $100,000 loan with no money down. So let's say the top $3,000, 3% on the top, okay? Let's say that's a tranche. And then the next 5%, that's a tranche. And they were packaging these tranches up and selling them as, and I don't want to get too deep into this, but here's what happened. They take this tranche of the top 3%, the riskiest loans, the houses are too high.
Sell at 12%.
And they would sell those loans. They would go to Standard & Poor's and Moody's, and they would rate them AAA.
Yep.
Now, when they put Standard & Poor's on the stand and said, why did you rate these as AAA? If they didn't pay us to rate them, they were going to pay Moody's to rate them.
Right.
So we had to rate them because they were just going to go to our competitors, and they were going to give them the ratings. So the two people that were supposed to be rating these loans, the bird dogs, were Moody's and Standard & Poor's, and they went with the money. And they decided to say, this tranche, which is the most risky tranche in the world, is a AAA tranche. And this tranche still, I mean, until you get to the 30% into the loan, like a bankrupt house, you're only going to get 70 cents on the dollar if you're lucky, maybe 65. So that top 30 to 35% was at risk on overvalued homes, and each tranche was rated AAA and sold on Wall Street to pension funds and all sorts of things.
I remember sitting in my office as a lender one day, and one of the agents came in from our office and sat down with me and said, I'm thinking about buying this house, but it's $650, and I'm looking, and it was just $450 in that same neighborhood a year and a half ago.
Yeah.
And I remember the two of us having a conversation thinking, oh man, we've created something that we're not going to be able to get out of, because suddenly a $450,000 house, instead of going up 3% or 5% a year, had literally almost doubled over a year and a half. And then we realized what's going to happen when the legs get knocked out from these loans, and everybody's putting no money down, so they're literally totally exposed to $650 on these houses that are really only worth $450 to $480. And so that, all of a sudden the realization came to the marketplace, why am I paying $650 for a house that's probably only worth $480? And that's what happened. It just,
you know why? Because everybody else is. If I don't pay it, somebody else is going to do it. Why?
Right.
Because there was so many more people in the market at that time that the floodgates opened, and people were walking in buying houses that shouldn't have been buying houses in the first place.
Yep.
So it was a really, really kind of weird and scary time, and you really never knew where the floor was at back in that day as it was going down. But there's blood on the hands of Standard & Poor's and Moody's and Wall Street that was packaging up these tranches. And to be honest with you, the FDIC regulates all these banks and should have been regulating the whole thing and making sure this stuff doesn't happen. So
it did.
If you watch the movie The Big Short, I think more than anything tells you how a lot of this stuff happened, and it takes you behind the scenes. So that's a good, and the reason why we talk about this is a history lesson. This is a don't let this happen again kind of thing. And this is how did we get here? How did we get where we are today? Why was 2007 values and 2017 values, why are they at the same place? Because 2007 was overinflated.
Right. It takes that long to get back to a value.
To get back to where it was.
It just shouldn't happen in a year like it was back in
Remember this, and again, people look at real estate and say, I want to invest in real estate. I don't think real estate is a good investment at all. I think real estate is a good hedge against inflation. So you own a house, you buy a house, you want to paint the walls. You can't paint the walls of a landlord. You can paint the walls if you own the house. So it's a pride of ownership is the first thing you want to do. You want to put your roots down. Your mortgage gets paid off over time as the value rises with inflation. And when it comes time to retire, I sell people's houses, the loans are paid off, they take $750,000, they buy a $400,000 place in South Carolina, and they're happy as can be, and live on the 300. So think of real estate as a long-term investment, not a short-term investment. But again, I think we've talked in days gone by, now that we're on the buyer side of this and the financing side, We've talked about this before with, and Leslie and all this stuff that if a kid goes in and gets an FHA loan, you're paying a lot of extra mortgage insurance and private mortgage insurance and whatnot. Whereas if they put up 20% down to buy a house, they get the best rates, best terms, best of everything, right?
Actually, you can do it now with 5% or 10% down. So
Yeah.
those loans are out there, and they're good loans. So you can actually put 5% down and get, I think, we'll have to talk to Mike, but almost the same rate as you could get with 20%.
Well, and again, I mean, things change. As you
Yeah.
and I just talked about, there's different programs, there's different
Right.
times. So it was very restrictive, and now it's loosening up.
Yep.
But if you look at the availability of funds back then and the availability of funds right now,
Yes.
it fell off a cliff, and then it's creeped up a little bit. So I'm sure they're loosening their purse strings.
They are.
And the only way to find that out, is work with a good correspondent lender. And again, we'll name, I can name a couple of them. First Heritage, the guy's name is Mike Filan. You can email anybody in the KC Samson team, and we'd be happy to put you in touch with him. And the reason we like to do that is because that's where we have all of our leverage, all of our focus. And to be honest with you, we've had lenders, and if we're going to refer somebody to a person, to a professional, they have to be really, 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 really good. So, and you may be a one and done if you call a lender and you get your loan. You're a one and done. He doesn't have ongoing business with you, so you may or may not get the best terms and best guy. We already know who the best people are: best painters, best electricians, best plumbers, best lenders.
Through years of experience, just using lots of different people and understanding who actually takes pride in their work.
Right.
It's very important.
Well, and you should use a realtor, your realtor, whoever your realtor is, as a source of, hey, have them refer you to somebody. Because when somebody says, Pat Sampson told me to call, well, that means something to them because they really want to make sure the price is right and everything's good. If anything's wrong, I got to fix it. I can't. So we have more leverage, or your local realtor would have more leverage over people.
Over the course of the year, I could send 20, 30 people to any particular vendor.
Right.
So they value their relationship with me, and they'll make sure that they take care of my customers, our customers, and they do the best job possible at the cheapest price possible, and to try to make everybody happy.
Right.
So it's very important to use the resources that we have, the years and years of resources, plus the fact that they're getting volume of business from us, and they're going to treat you much better. Plus, you've got us in between to help.
Right. And should something go wrong, it's a one call.
Yes.
That was, let me just make one call.
right.
But the real reason why we send them out is because those people we believe to be the best, and the best for our clients, or we wouldn't refer them out. One footnote, and again, this is when you look at realtors, they just don't list and sell your house. There's a lot of things that you need to use a realtor for. So, we go out months and months ahead of time. Should we put on a kitchen? Should we not put on a kitchen? Should we do this or should we do that? Even if they're saying we're going to remodel a kitchen, what is saleable? Quartz countertops, white cabinets, these kind of floors, this kind of stuff. If you're going to make an upgrade in your house, you have to consider two things: A, what you love, need, and want, and B, what is a resale, what is saleable. Like I said, Billy and I went to a guy's house, and I said, well, the first thing we need to do is we need to paint this dang house. And he goes, what are you talking about? The painter just left. I said, wait, what? He just painted it. He painted it Redskin colors because he was trying to attract a Redskin fan as the buyer. Nobody's going to buy a house that's colored for the Redskins. Just trust me. I mean, I love the Redskins, but I don't love the color. But it's not a house color, okay? So if you're planning on painting, I can't tell you how many times I come into a house and somebody says, we just painted it. And I'm like, why would you possibly paint it in 1985 color? There are 2015 to 18, 19 colors. So let's get the proper color in these houses. Let's have the proper trim. Let's get the proper doors. Let's get the right hardware. And a lot of times we'll come in and the house will be prepared for sale, and they're like, oh my God, why didn't we do this years ago? So I have no problem if somebody calls me and says, Casey, can you just come by our house? We're thinking about doing some upgrades on our house. We're thinking about updating some things. Can you come by and just tell us what is the most saleable? What is today's thing? So if you walk into new houses or, the really remodel house. What are they going to see? I mean, what is today? And let me give you a perfect example of this. In 1995 to 2005, they have gold and brass handles on a house. All the doorknobs, all the little levers, all the brass. Well, you know, there comes a point in a time where that really should have converted now. Remember how we were talking about the cone, the houses that have been updated, the houses that have not been updated, the cone of value. A house that spends $2,500 to $3,000 on all new hardware, see those brass doorknobs or the doorknobs you have over there, if they are all of this, the newer stuff, man, go up top of that cone, you get your money back. So some things you really get your money back, some things you do not. So, you know, it's not bad to call in your realtor, even though you're not selling, just have them come in and give you some advice on what you should be doing with your house. Agreed?
Yes, and the best way to visually see it is to go out and do open houses at new homes, new homes. Go in and see what the builders are doing, because they're the ones that are selling to today's clients, and they've gone to great extents to determine exactly what people are looking for.
Right.
So if you really want to picture what your house should look like, go to a new construction area, go to an open house, go to all the different open houses in your neighborhood, get an idea of what everybody's doing to their houses,
right.
Why this house has been there for 100 days and hasn't sold, and why this house sold in 6 days.
For a lot of money.
There's a lot of clues in there for even more money in your neighborhood on the same model home. There's a lot of clues in there. So it's very important to get out amongst all the homes and look at all the open houses and whatnot.
Right.
The best place to go is the builders. The builders are the ones that are sinking tons of money into lots of homes. And most of them are spec homes, are building them before they even sell them. So they've got a pretty good idea of what it's going to take to sell that.
They got interior designers.
They've got designers.
The industrial,
right.
If you look at the industrial lighting that you see in a lot of these houses right now, if you look at the plumbing fixtures that they're putting in, the hardware they're putting in, and you know, it's funny, I just went to a house and they just finished putting in some brand new Ubatuba granite countertops. It's like, well, Ubatuba's out.
Right.
Yeah. You just put in a 1995
That's right.
granite. So, you know, you really have to be careful if you're going to make an expense on your house. Let's, A, make sure you like it, but B, let's make sure we get your money back. Because right now, to be honest with you, the granite's out and the quartz is in. So if you're going to do your countertops, get you some nice quartz. There's a lot of good stuff you can do that we as people we can refer you to get all that stuff. But if you're going to sell your house, we're the people to call. If you're going to buy a house, we are the people to call. Plenty of experience, and our team is combined with some older, more experienced agents. Between Pat, me, and Pam, you probably have 80 years worth of experience, and then we have a bunch of wonderful, smart, young 30-somethings, which are our buyers. So when we go into a house, I may look into it and go, you know, I really like this, and Kelly's like, no, we're changing this, we're changing that. So Kelly and Billy and Colby and Morgan and Shayna, they are our buyers. So it's a great combination of the old school and the new school that can help you out. So if you want to reach me, you can reach me at casey@caseysamson.com. If you want to reach Pat, you can reach him at pat@caseysamson.com, right?
Yep.
Is that good?
That's good.
And so if you have any needs on selling your house, you know, it's a big deal to get in the Wall Street Journal. It's a big deal to get, you know, $95 million. But the only way you get the $95 million is $1 million at a time. Every house is important. Every house is critical. Every pricing model is critical. And regardless of how big our thing gets, I get to every house. I make sure I get the condition and the upgrades correct. With the help of the alt agents, we make sure it's priced correctly and launched. And the lovely Julie is, again, one of the big, huge assets of our team and why we look so great. She is the icing on our cake, as well as Michelle, who is our director of communications. And again, if we go in and do a lot of withdrawn listings, and I say, what's the problem? What happened? Can you share with me what happened? They said, we were listed, get this. Billy and I walked into a house the other day. It was listed with a famous agent over here in Oakton. It had been on the market for 2 years. You know how many times it was shown in 2 years? I said, did you ever get any feedback? He goes, we never had a buyer. Or we never had anybody walk through the house. I said, you had not one showing in this house in 2 years. No. So the real wonderful thing about Michelle, and again, a smaller team can't afford her, and a bigger team dilutes them, but Michelle make sure that every seller every Monday has an update on how many times your house was shown, what the social media reports are, what does Realtor.com say, what did the people that saw your house, what did they say? You know, all these wonderful things on these charts and graphs and everything. So it keeps the sellers aware of what's going on with your house. I mean, I truly believe, and it's not that I believe, it's because it's a fact. Your house needs to sell in the first 30 days. This is 2018. If it doesn't sell in 30 days, we have a problem. Buyers are out there. You know, this is not a wait and see. The buyers are out there. They're on the internet. They're looking for your house. If we miss it after 30 days, that's not a good thing. So it's important that I see it, that Pat sees it, that the alt agent sees. This didn't sell. What are the buyers saying? What's the traffic? Because we need to show a house at least 7 times in 1 week in order to receive a contract. So if it's not getting that kind of showing, we have a problem. Let's say 0 times in 2 years. So you know, one of the assets of a team like this is big enough to afford somebody like Michelle that can keep, you know, provide those goods and services to the sellers that, you know, in my opinion, makes a difference. So thank you very much, Michelle. Thank you, Julie. And, you know, Samson is blessed to have somebody like Leslie come in here, and she's a social media person for Samson Properties. She puts all of our meetings online. She's really taken us into the next phase of all of this. So you do a wonderful job. You and Mac do a great job. So thank you very much. Is that it?
I think that's it.
Is that the show?
I guess.
It's time for Julie to dance?
Yes.
All right, Julie, it's time to dance. Let's go. All right, we'll see you next month. You can give me a call at Casey Sampson. Email at Casey Sampson at Casey@CaseySampson.com or 703-508-2535 or
703-380-7025.
you can't miss. We'll see you next week.